Hey guys, Killstokes here. Hope you're having a great holiday. With the markets being pretty quiet this week, there's really nothing meaningful to look at and break down live. So instead, I want to share with you a trading lesson that I've been actually holding back for about a year now. In this video, we're going to do a technical walkthrough of a trend continuation opportunity, but more importantly, I'm going to show you how technical analysis can help you anticipate where price is most likely to go using different tactics like Fibonacci's, harmonic, structure, the regular stuff if you're familiar with this channel. Now, the reason I wanted to release this video now is because we're just coming off the video where I taught you guys about moving averages, and we even built like a really simple strategy on how to use them. And well, I just wanted to revisit that idea, give you more reps, but also show you different ways that we can implement and even blend kind of a mechanical trading strategy with a purely price action and technical setup. Now, full disclosure, I haven't looked at this setup as far as the moving average thing, so it'll be interesting to see if what we add actually helps or hurts the trading opportunity. So we'll start with a recording of the original analysis, then I'll hop back in and kind of blend everything back together. But before we do, I want to remind you guys that the full recordings of our recent trading mastery workshop are up. It's about 8 hours of training for you. They're only up until the end of the year, so please do not procrastinate. Check them out now while you have the chance, because I don't want emails saying that I missed them. I've given you so much warning, so just do it. All right, let's hop in. Hourly chart, right? So we've been trending downwards, right? We've been creating lower lows and lower highs, right? So we are in a bearish trend, right? Price action has retraced. Where is it retraced to? Look left. Structure leaves clues. You guys know what this is. If you don't, I'm going to show you. Get used to it. Elephant. Insert the noise. I might hire an elephant just to make that noise since I've failed so many times. But you guys see this elephant candle, this big candle right here? Give me a yay just to make sure. Big red candle. And then the consolidation zone before it. Yep. Good clue. Look left. What else do we have there? Right? That's our previous structure low. Classic trend and structure rules, right? It doesn't get any, this would have been something that if this were to happen last week, I would have showed it last week in the webinar. It's perfect example of that, right? And no surprise that price action comes here. Probably a 618 Fibonacci retracement as well, if I just had to guess, right? Fibonacci retracement, swing high to swing low. Sheesh, you're so good, Akil. Man, are you ever wrong? No, I'm never wrong. So perfect retracement right there, and now we're following through. So the expectation is this, and this is going to change a little bit depending on your philosophy as a trader. A true trend trader is expecting another extension, a continuation lower, right? Different ways to predict where we're likely to continuate to. I'm going to erase this stuff. What are some ways? Before I give the answers away, I want you guys to work. What are some ways to predict on where this trend may continuate? Paul says AB equals CD. Yep, AB equals CD, equal measured move. So swing high to swing low. I'm going to copy and paste this. That's going to be my A to B. This retracement is my B to C. I copy to the retracement. And if we're moving harmonically, right, we should expect an equal measured move. I don't know if we had that before as well. We may have actually done that before as well. Bang, look at that. A little bit off, but these things aren't perfect. So let's mark up that AB equals CD. I like to put a line there. What else can we do? Ann says Fibonacci extension, and you're dead on. Fibonacci extension, that same swing high to swing low. I'm going to move it to the side a little bit. That way I can actually make sure I grab the marks. Fibonacci extension, swing high to swing low, and back up. And you can see that we have a few things here. We have a 127 right there. We have a 1618 a little bit lower, right? So I'm marking up these zones. What else can I use to kind of predict where price action is likely to go to? Right now I've got two things lining up in the same area. 127 Fibonacci extension, and I've got an AB equals CD pattern. What else can I use? Yes, look left, right? Structure leaves clues. So let's zoom out a little bit. Again, I may need to hop to the 4 hour just to get a little bit better perspective here, but let's look to the left here. Let's see if there's anything, or let's see what is here that we need to pay attention to. We've got structure stair stepping all over the place. Hey, Cody. But yeah, this comes right at a structure level too. Again, we don't have a great level of structure, but it does come at a structure level as well. So not a bad place to expect that that's where the extension will come to. So again, two ways of thinking this. If you're a trend continuation trader, you're expecting this extension to happen. If you are maybe not a trend continuation trader, so for example, I'm a counter trend trader at heart. I have a firm belief in structure. I do not expect structure to be broken until it is actually broken. So my expectation is that price will come back to retest the lows, right? Think of this as first stopping point, second stopping point. So now this would dictate your trading opportunity, right? If you were someone that, I'm assuming the double top was up here, or double bottom, or yeah, double top was up here somewhere. Now we have our prediction levels, right? These prediction levels would also become target levels. Does that make sense? Right? Our target levels for a trade are no different than where we would predict price to go. That's the funny thing about trading. That a lot of people, I was speaking to a person the other day and they didn't understand this, where they're talking about targets and like the typical question is started off, Akil, where should I put targets? And I'm like, the typical Akil answer, where do you think price is going to go? Well, I think price is going to go here, but where should I put targets? I'm like, well, if you think price is going to go, I'm trying to give, if you think price is going to go there, then yeah, whatever. Where do targets go? And I'm like, but we complicate targets sometimes for weird reasons. I don't know why, but picking targets is, I don't want to say easy, right? But it's simple, right? You place your targets where you think price will go to. Right? Is there anything too confusing about that? Now, I'm not saying the process of like finding that level is easy, right? It takes analysis. That could be very, very hard. But the general concept of like, where should targets go? Where do you think price is going to go? It's rather simple, but we tend to look at them in different lights. We tend to think of like, I'm going to do analysis, but targets have to be different. No, like they're the same thing. So that's why I say the better you become at analysis, the better you're going to become at predicting targets, and the same goes for stop losses as well. So let's head down to the 15. Let's see what Jason was talking about in the London room. My guess was what? Was he looking for a double top up here? Would this have been London time? Yep. So that would not be a double top for me because of my rules for retracements, right? The fact that this valley of the double top came back to retest previous structure. So it technically couldn't be a double top for me, and we actually technically didn't get a double top either. That sucks. But the entire premise of the trade, getting short on this pullback, I love it, right? What did we talk about? Where did price come to? That elephant candle, right? Where was the consolidation prior to the elephant candle? Right here. So we had structure. We drew it out earlier. We had a 618 Fibonacci retracement. We had everything lining up in that level, in that zone. We even had a nice, well, again, I won't ruin it for you. There was another entry reason. I can tell you right now what I would have taken. I wouldn't have been happy about it actually, but I would have taken it. You guys see what we had here? And this is a cool practice that you guys should be doing. We talk about journaling and reviewing your trades, right? Playing in the sandbox, right? Obviously, this trade happened during the London session. This is not anything that I can take, but a great practice for getting better with your trading is going back, reviewing the tape, and asking yourself, okay, how could I have gotten involved in this opportunity, right? This is no different than a professional athlete. What do we do after a game? We go back and watch film, right? After a game, I would go back. We have the guy who cuts up the film. I would watch every single one of my plays. The good ones to see what I did good. The bad ones to see what I did bad. And just overall to see like what I could have done better. All right? And then you improve from that. You learn for next week. Okay, I shouldn't do this, or I didn't see that, or I should have read this, right? And you get better. As traders, we should be doing the same things, right? We should be doing it not only on our trading portfolio, but I like to go to random pairs and random asset classes because it kind of takes the cheating value away of it. Like when you're trading a portfolio, you kind of know what's happening. It's a little bit harder when I jump to like silver. I'm like, oh, I don't know what silver's doing. This is kind of new, and it's, I don't know. For me, it's fun that way. Probably because I've looked at the same 9 pairs for like the last 15, 18 years. But it's a really, really good practice. So yeah, 3-bar reversal. So we get a beautiful 3-bar reversal right here. If we can count 1, 2, 3. Now, I tell you what, I wouldn't have been happy about entering this. And this was something that we spoke about in the workshop yesterday. So 3-bar reversal, right? High momentum candle, right? This is a nice, strong, bearish candle. And then we have a lower low, lower close, which is the trigger. However, this lower low, lower close is a weak bearish candle. Now, quick pause. If you're interested in learning more about candlesticks and strengths and weaknesses and how to read them, 2 things you can do. One is you can check out those recordings from the Trading Mastery Workshop. I think we do it on day 1, session 2. You can learn all about that. Or if you're seeing this video after the recordings have already been taken down, what I'll do is I'll link in the description box below another video here on my YouTube channel where we teach you about candlestick strength and whatnot. Right? Now, I told you guys you can go and test it to see if it makes a difference. I've never tested it. For me, a lower low, lower close is a lower low, lower close, no matter if it's strong, weak, or neutral, as long as it breaks below, closes below. But just looking at it, you're probably like, right? You're probably getting the nervous tinglies. But lo and behold, again, it broke and closed below. I'm going to go sideways for a little bit, and then it ended up going in your favor. But that's a perfect entry reason for you as well. Cody says, lovely trade. 2 of my buddies are in shorts here, both old members of Tier 1. Yeah, look at that. We've taught them well, Cody. No, I think it's a great trade. Again, everything lined up. And before we even got to the 15 and saw the reason for entry, right? Everything lined up with the zone. It's a no-brainer zone. This is stupid, dumb no-brainer. And if you're someone that's into active trade management, now you're trailing. If you're looking at this and you got in originally, let's put it right here. Stop loss 36, 46, 51, right? Stop loss initially about right here. Let's say you're shooting for retested lows because you're a scaredy cat like me. Retested lows right here. I mean, you look at that risk reward 4-1. Amazing. My secondary target would be the extension, but some of you guys may be shooting for the extension with the first target, right? So what happened was, if I move this to the side a little bit, price action did this. This is a good example of active trade management. Price action pushed down, we retrace, and then we created a new structure low. What does this allow you to do right here? Does that confirm that price is moving in our direction? Yes. Yep. We can roll stops if you're allowed to roll stops. So that puts us at 24, 34, 39, right? If you're doing by 1 ATR. Again, everyone's method is going to be a little bit different. If you're doing by 1 ATR, it's going to be 39. Boom. Now you're right here. So you're reducing that risk as price goes in your favor. Excellent trade. I'm curious to see what this looks like on a range bar chart too. This is what a 16 period ATR. Let's do a 13 range bar. Just curious to see what this looks like. You may have gotten your double top on a range. Oh, you did. This is a 21 range. Let's go to a 13. You can see a similar situation on the range bar chart. Same thing. Probably gotten at the exact same moment, but a little bit smoother. Now the cool thing about the range bar charts is they give a little bit of a better ebb and flow. So what you see here on the range bar charts that you didn't see here on the the 15-minute chart is that we came down, broken close. We then did this, broken close below that. So on the higher time frame, we were stuck at 39. Guess what? This one, we can roll it down even more. This would be 76. So now those stops are right here. So now those stops are what? In profit. So we're worst case scenario. If this thing reverses, you still made 40 pips. How's that for a worst case scenario? How you like that? You like that? Kirk Cousins fans out there. Yeah. So that's a little bit of the advantage of a range bar chart. Again, there are pros and cons of range bar charts. One of the advantages of them is that you see a little bit more movement. Now, again, more movement is a double-edged sword, right? More movement or different looks at movement allows you to roll quicker. It could also get you in trouble because this thing could shoot back up and then do this, and then on a higher time frame, you never would have moved it. Now you're stopped out. So I don't want to make it seem like it's always great. It's different, but it allows you to be if you're looking to be more aggressive, and that's as a day trader, that's something that I always want to be more aggressive. It allows you to do things and see things a little bit quicker. So good trade here. Just curious for you guys, are you more trend continuation traders or more like? Would you shoot for first targets all the way down at I forgot the number we're at, but at the extension? Or would you be looking to take something off here? There's no wrong or right answer. I'm just curious where you guys philosophies are at. I'm a scaredy cat. I'm structure. Sorry. Half off at structure. I'll leave half on for the extension. All right, so let's revisit our trading opportunity. Remember, we were looking for an idea right here at this little pullback. This was our beautiful structure shelf looking left, and we were looking for a short trading opportunity here. Now, if you are someone like me who took the scaredy cat targets, right, for target ones, boom, they hit right there. If you're someone that was looking for the extension, I believe we were a little bit short. I think they were down here in the 87.70 somewhere. So we did extend past, but we did not quite get that follow through. So what I want to do now is revisit the ideas that we looked at in the previous videos. Remember, we took a look at EMAs. We talked about 3 ways to use them: as a directional filter, as an entry indicator, and as an exit indicator. We spoke about the SSL as well. Maybe I'll bring that on as well to see if that helps or hurts it. And again, this is my first time looking at this, so I don't know if this is going to be beneficial or not, but this is what we do during the winter. This is the playing around in the trading sandbox where we're just going through charts, we're looking at ideas, and we're trying to be creative, we're trying to learn. So let's start off by using our directional filter. I'm going to draw a line. This was our entry right here. If you guys remember the 3-bar reversal. So this red candle right there was our entry. We'll remember that. Let me just put this, maybe I'll write entry here on top of this so we remember. Entry, there we go. That way we know it is good. All right. So let's start with our first one, which is our directional filter, and I hope this is the right EMA. Yep, there we go. Big yellow one. So this is going to be a 200 period moving average. And if you remember, our directional filter, the idea behind it isn't to tell us when to get into the trade. It's not to tell us when to get out of the trade. It is pretty much to give us a filter that says, yes, we can enter the trade in this direction, or no, we can't enter the trade in this direction. And the if-then syntax behind them, I was just working with a trader on the platform who is going through strategy development. So I'm talking about putting he has all these ideas, and like, we'll take these ideas, put them into something called the if-then syntax, and that's how that's step 1 of creating trading rules. So if we were creating trading rules for this, the if-then syntax would look like this. If short trading signal occurs below the 200 EMA, then thumbs up for taking trade. If bearish trading signal comes above the 200 EMA, then thumbs down for taking trade. So if we're still looking at our entry signal as being the 3-bar reversal, so we're kind of blending the mechanical and discretionary trading here, you can see that, well, my entry, this white line, it occurred as price action was below the EMA. So this would be a thumbs up for trading. So again, in the previous video, we looked at building a strategy simply off of moving averages, and 99.9% of the other videos I do here on YouTube, we talk about building a strategy simply based off of discretionary price action trading. This would be how you can combine both. You can be a price action trader and still use indicators to help give you those filters. So still would have entered a trade right here. So our directional filter would have given us a thumbs up. So let's go to the next one. Let's look at an entry filter, and let's put these other EMAs on here. I forgot what they were, but I think one was 10. Let's see. Yep, one was 10 and the other one was 25. So the white one's gonna be 25, the pink one's gonna be 10. So if you remember correctly, for our entry filter, what we need is we need the pink, for the fast EMA, to cross below the slow EMA. So the pink to cross below the white. And that doesn't occur until right about here. So in this scenario, if we're using an EMA cross for that entry reason, and if we're using these specific settings, obviously we spoke about changing the settings to kind of fit your liking, we would have gotten a much worse entry. We still would have been in the trade. We still would have caught all of this move down here, but you can see we missed out on about 60 pips or so. And this goes back, not to kind of prove a point here, right? Because that's not the point here, but we talked about, I made a comment the other day, and I've gotten mixed reviews on the social media world here, right? About indicators being lagging, and kind of the premise that a lot of people think like, well, a moving average is going to tell me what direction price is going to go to, and it's the exact opposite. Whatever indicator you use, not picking on moving averages, but price is going to dictate what the indicator indicates. And this is a perfect example of this indicator isn't going to cross and give you said signal until price has already decided to go. Now, that's not a bad thing. It is a safety net, right? If this move would have blown straight up from here and went to the moon, you never would have been involved, right? So it kept you out of danger. But again, a good example of showing you how the moving average isn't predicting price. It's more so confirming price. So in this scenario, the exit indicator or the entry indicator isn't going to give us much help here. I'm just going to enter MA cross entry. The last one, let's see if the exit indicator would have helped us any. So we know that from a price action perspective, we were looking at two areas for targets here. We're looking at area number 1 being right here for our target ones, and we're looking at area number 2, which is down here at a 127 Fibonacci extension. So let me draw that on. Here we go, down here being our target 2, and or target 2, depending on what your method was. By the way, I cut out a portion of the video where I went on this rant about the psychology of picking different target areas. I think, don't hold me to it, but I think I wanted to share it to you, but you guys on YouTube hate when I get all wordy and do stuff. But I think I'm going to share that in tonight's episode of the Trading Coach podcast. So if you want to hear about kind of the psychological battles of shooting for larger profits versus smaller profits and balancing that sanity and profitability, make sure you tune into that. It's going to be an audio only episode, so it won't be here on YouTube, but you can head over to Spotify and check that out. But you can see target 2 wouldn't have been hit right here, or the extended target, I should say, wouldn't have been hit right here. So from just a pure basic perspective, if you're someone that only took target 1, so the mechanical approach, you only took target 1 at the MA cross, right? You would have entered here, or let's say you would have, there's so many combinations we can do, you would have exited the trade right around here, right at this red candle right here. So this gives you a few different scenarios. If you entered based on price action and exited based off the moving average cross, you would have been down here for about 84 pips. If you entered on the moving average cross and exited on the moving average cross, you would have been here for about 23 pips, right? So in either scenario, both wouldn't have been as profitable as simply entering off of the price action signal and then exiting off of the structure-based trading idea. And again, there's so many ways to use this. So let's just say that in this scenario only, right, the moving average cross entry wasn't great. The moving average cross entry wasn't great. But what if we were using the moving average cross entry as a trail stop method? So there's many ways to trail stops. And there's another thing that I want to put on that I won't put on because I don't want to bring that into the conversation. Now I really want to do it now, the parabolic SAR. Ooh, but let's just say we're doing something like this. We're creating a strategy where we are entering off of our price action signal. We are exiting off of our analysis-based signal, so structure, fibs, whatever we use to decide that. But we are managing our trade, so our exit, our trade management, active trade management exit is going to be based off of that moving average cross. And what that would mean is this. If you are a trader shooting for either target 1 down here at the extension or target 2 down here at the extension. Obviously, this didn't get fulfilled. So what you're doing is you're entering right here, right? Your stops were somewhere around there. Now, there is no place to trail stop structurally wise here, right? So what happened is after you hit target 1, if anything, your stops were probably rolled to break even. If you never hit target 1, your stops are probably up here. So what happens is, right, instead of seeing price action come all the way down here and then come all the way back up and take you out for a losing trade or maybe even a break-even trade on secondary targets, what this allows you to do is at least get something out of those secondary targets, right? So let's say you took profits on your first target right here. Boom. You rolled stops down to break even, protected your risk on the back end. Now it's a risk-free trade. You can't lose any money. Well, now instead of having the second half of your position go all the way back up for nothing, you still made a little bit. You still captured, where's that entry exit at? You still captured 85 pips on your secondary target. So you went down here to get 160 on your first target. You got 80 on your second target. That is much better than having 160 on your first target and then zilch, zinc, 0. Zinc? I forgot the other one I used the other day. Zilch, zinc? Zinc? No, zinc is a metal. Anyway, from getting donut hole, right, on your secondary target. So using that moving average cross as an active trade management or I don't know what the wording would be, an emergency exit call could be a profitable idea here as well. Now, let's go back to the indicator I showed you at the very end. It was going to be the SSL channel. So we're going to delete all this and bring on that SSL. I told you I like this. Let's see what type of signal this would have given us. And again, allow me to change the colors a little bit just so they're not too confusing here. Let's make this one white, and we'll make this one, there we go, white and bright. Let's make this pink. There we go, and boom. So if we're using this SSL channel, both our exit and our entry, well, let's see what this does here, right? So our initial entry for the price action trade was right here. You can see our SSL entry would have been right here. So yeah, again, it's not as high as the initial entry, but you can see it's a lot higher than that moving average cross, right? This one was only about 20 something pips away from our price action entry, where the moving average cross was about 60 pips, right? Now the exit, this is where things get a little bit better as well. We did not get an exit signal right at the lows here, but you can see the recross happens right about here. So you can see much better than that moving average exit. The moving average exit was right up here. Our SSL exit was right up there. So again, if we're going from just SSL signal to trail stop or stop out, that's about 108 pips. If we're going to moving average cross, we did that already, it's only about 60 pips. So again, although not as ideal, and this is just one scenario, not as ideal as the price action trade, you can see this method was a lot better than the moving average entry, even if we're just using it as kind of an exit indicator for, again, trailing stops or just an exit indicator in general. And again, what you would want to do in this scenario is just kind of finagle with the settings. I don't know what this is going to look like, but let's make it, I forgot what we did the other day, 5 maybe, 5, see if that changes anything. Well, 5 gives me more chops. I get a false signal right here, I'm stopped out, and I have to enter again right here. It does give me an optimal exit down here, but I did take a few losing trades up there. So maybe we go 7. 7 is going to give me about the same. 6, let's see. 6 is going to give me probably the best, a little bit of a better entry and exit, but you can see nothing's going to be as good as the price action deal. But again, the idea is you want to play around with these things. So I bring this up because I want to talk about this, right? Oftentimes we think as traders we have to be on one side or the other. We have to be either fundamental traders or we have to be technical traders. We think that we have to be price action traders, discretionary traders, or we have to be mechanical traders. But the truth of the matter is there is a nice healthy blend of everything. I've been watching so much stuff on Avengers Doomsday, so I'm thinking of like Loki holding like the tree of life and all these different timelines, and all those different timelines are different methods of trading and how they can all be used together. We spoke about hybrid trading on the technical side, where it's like, hey, I shoot for home run trades when I have a technical setup, but I also have a fundamental setup or a fundamental idea that is aligned with that technical setup. The same thing could be used for this, right? You can create a strategy using indicators and indicators only, right? It's black and white. Or you can create a strategy using a price action discretionary trading style, but use your indicators to support that as well. It doesn't have to be one or the other. And I think newer traders just don't hear that enough. So I hope you enjoyed that. If you like these types of videos, let me know and I'll do more of them. If you have any questions or comments about anything discussed here, let me know as well and I will bring them up. And until next time, plan your trade, trade your plan, and wish you guys a very happy new year if I don't see you by then. And again, look out for tonight's episode of the Trading Coach Podcast, where I'm most likely going to share the end of the discussion about balancing profit taking and mental stability. All right, see ya.